So we're building towards a future that actually, ironically, looks more like blockchains did before rollups arrived, which is that state growth and state size and so on is the ultimate bottleneck. That was always the case, really. It's just currently obfuscated by expensive call data, and this is a transient thing. It will go back very quickly to call data is cheap and state is expensive. And when we're in that in that place, Fuel is well positioned to be way ahead of any other rollup that isn't actually working towards this.
All right, everyone, welcome back to another episode of 0x Research presented by Chainalysis and Flipside. Today is January 23rd, and we have a great interview with John Adler, who is heavily involved in the blockchain industry as a whole. But specifically today, we're talking about Fuel Labs, which is an execution layer built for a modular blockchain world. So a super exciting conversation. He is insanely smart and intelligent, and you can really just tell his passion for blockchain as a whole. And it's a great conversation. So, before we get to that, as usual, we have our intro segment, and we are joined by Ren and 0x Pibbles from the Blockworks research team to discuss the latest market happenings. And we'd like to do this through a segment of Hot Seat, Cool Throne. So, Ren, I'll kind of throw it over to you. Who do you got this weekend? Are they in the hot seat or the cool throne?
Yeah, I got the Wormhole Exploiter in the hot seat. So I remember in around February of last year, Wormhole got exploited for around $300 million at that time, which was around 120,000 ETH. The exploiter then bridged around 90,000 worth of ETH to the Ethereum mainnet. He's been on the move again today. He just turned 95,000 ETH into roughly 95,000 staked ETH, and is now the fifth largest holder of staked ETH. He's then gone on to borrow some DAI against that and has swapped that back to staked ETH. So he's in a very, very leveraged long staked ETH position right now. We're not really sure what the end goal is here. It seems like maybe he's bored. He just wants to leverage long and degen a bit. Maybe part of him wants to get liquidated on the Aave loan, but it's hard to say.
Yeah, no, this is definitely an interesting one, right? Like, every time I see these massive sums of money getting stolen, the first question is like, all right, well, how are you going to get that off chain? What are you going to do with it? And the reality is, it's not that easy to just take crypto and turn it into dollars or whatever currency of your choosing, without being able to do so without being like regulated. So the reality of the matter is, even if you pull off a massive exploit, you're really just kind of trapped with these on-chain dollars. So while it's probably something more interesting than him just getting bored, in my opinion, it does like beg the question of like, all right, well, what's his game plan here? But at the end of the day, it very well just might be a degen just trying to have some fun on chain.
Is it Lido's Steth that he's levering up? Okay, it is. Yeah, I wonder. That's interesting because that makes me think maybe he's like purposefully trying to get liquidated, potentially pull staked ETH off peg, and then buy up that discount on his PA. So maybe that's one angle. I think Macaulay kind of alluded to something similar. So sorry, Macaulay is on the editorial team. So shout out to Macaulay. But I can go ahead and jump into my cool throne of the week. This one's pretty easy. Circle. They just released docs over the weekend for CCTP, which is cross-chain transfer portal. And they're describing it as a utility for anyone to permissionlessly go in and burn USDC on a source chain and then mint it on a destination chain. So you'd always have native USDC. And that's pretty huge in the bridging landscape of things because that's commonly been like one of the biggest hurdles in crypto UX and security. So to see them making this push forward is super exciting. And honestly, I can't imagine there aren't going to be some fee revenue generated off of this. Maybe I'm wrong, but it's once again another bullish circle development. And normally how bridges work is you lock up an asset on the source chain and then you actually mint a wrapped asset on the destination chain. So that kind of creates a huge target for hackers to kind of target the native assets on the source chain because there's so much value just locked up there. And, we've seen billions of dollars of bridge hacks as a result. So this will definitely improve security as well as improving the user experience.
0x Research listeners had this one first. Actually, it was the DYDX episode a little over a month ago with you got the first little sneak peek of this exact thing becoming live. I think DYDX is going to leverage this and help them get USDC inflows into their protocol. And even a couple of weeks ago, this still wasn't being talked about. I actually fired off a tweet that was like, this is the most under discussed development in DeFi. And today that's no longer true, right? This has been kind of the talk of the town, and rightfully so. It seems like a great way to kind of circumvent the bridge risk that we commonly deal with. I guess the drawback or the downside of this is it, obviously Circle is a fiat-backed stablecoin that's very regulation compliant, and for like the decentralization maxis, this still might not be attractive to them.
Yeah, I am a little concerned on like how permissionless it's going to be. Like, what if you have to like, I don't know, I could see like down the road, they're like, all right, you have to KYC if you want to use this bridge. Like the same way you would have to KYC if you were trying to actually cash out on the Circle website, which I don't know. I don't know anyone who's ever done that personally.
That's a good point too, Pibbles. It's like if it becomes super ingrained in the main way to transfer value cross chain, they kind of have like a stranglehold on DeFi, kind of an angle I hadn't considered and something to definitely keep an eye on going forward, because last thing we want is KYC from Avalanche to Solana to back to Ethereum. Like that just sounds like an absolute nightmare.
I would say that bridge liquidity would still probably exist, but there definitely is a world in which no one would use multi-chain bridges anymore, such as Synapse, Hop, because one could basically go from, say, ETH to Avalanche by swapping ETH to USDC, burning the USDC and then minting it on Avalanche, and then swapping that for AVAX on Avalanche. So maybe there's an equilibrium there between bridges and Circle CCTP in terms of sort of the slippage that you experience on a DEX versus the fees that you would get on a bridge. But I do agree that the KYC concerns still stand.
Yeah, I mean, if this is a very low fee way to transfer between ecosystems, transfer value between these ecosystems, I have a hard time believing that this wouldn't become one of the most popular ways to do so. Granted, the risk seems low, the efficiency seems very high, and I think those that combination tends to do very well. But to jump back over to a hot seat, I've actually got optimism in it this week. Everyone kind of saw the charts circulating around of total transactions and activity on chain between Arbitrum and Optimism, and quick shill for the Blockworks Research Dune account. We've got a great dashboard comparing the two. But everyone kind of saw these charts circulating around saying how Optimism is, crossed over Arbitrum, and people are users are loving what's going on Optimism. And then their Quest program ended, and that we just saw a near crash to zero in terms of on-chain activity, and that really just gives credence to the fact that it appears the entire usage was just truly incentivized hunting. And there's they're giving away these NFTs. There's likely a second OP airdrop that's related to the activity done in these quests. And the quest ends, and we get a straight to zero plummet on these activities. So I don't know. It's hard to make of what this really is, but at the end of the day, I think it really just kind of shows you that if you really need the developers to be building valuable products on your chain if you want the users to stick around.
Yeah, I think this is a fair hot seat. Those transaction counts and daily active addresses pretty much halved overnight, just because people were trying to farm, whether it's the NFTs or whether it's a potential future OP airdrop. I also know the OP tokens 4 or 5x off the lows, so that's only driving incentives even further. But yeah, I still admire the Optimism vision, with Bedrock and kind of a modular stack that they're trying to build out. I think it fits really well in line with what ZK Sync's doing, what Starknet's trying to accomplish. And really you see every L2 trying to put together an L3 or modular stack strategy. So I am bullish on Optimism as a chain going forward. And I think they're going to accomplish some really cool things. But yeah, there's no doubt that not all that activity is actually organic.
I think one of the larger implications of the drop in transactions and Optimism would be for Arbitrum. Arbitrum's probably Optimism's largest competitor in terms of L2 these days, and does not have a token yet, even though everybody's sort of expecting a token at some point. So now the question becomes, what should Arbitrum do when they eventually release a token? Should they do a similar airdrop or a farming program? Or would that perhaps be net negative for the ecosystem as users or traders using the ecosystem transfer the mental model from I'm here for the good tech and the cool protocols to I'm only here for the token airdrop? And I think that's something that's very important to consider, not just for L2s, but also just for, in general, airdrop programs in the future for different ecosystems and L2s.
Yeah, that's a great point, Ren, especially when you consider, if you look at the UX between Arbitrum and Optimism today, it's really not that different. On the user's end, I think the way it feels, the way it interacts, the time to your transactions, for the time it takes for your transactions to be completed, it all feels generally the same. So the reality is the users aren't going to get, I haven't met that many people. Of course, there's always the maxis out there, but I haven't met that many people like, I'm only using Arbitrum because I love the tech, especially when you're comparing between L2 and L2. So it really comes down to the application level and what's there, what are people using. And, right now we see things like GMX really leading the way for L2s.
Yeah, I think it was Sisyphus I saw on Twitter tweet over the weekend, like Arbitrum, like all these other L2s without a token, they're not going to be able to keep up with Optimism because they do have a token and that they're wasting time. But I view it as completely the other way around. Like I view like a token allocation as like the protocol's ammunition to like continue to attract users. And the longer Arbitrum and ZK Sync and these other L2s can like maintain a strong community without a token, I think the longer their runway will like ultimately be. So sorry, sis, I do not agree with you on that take.
I think that's spot on, Sam, especially when you consider like, okay, well, what's the utility behind OP today? Okay, not much. Like when it's actually decentralizing the sequencer and playing a key role in the ecosystem and has a value accrual, all right, well then, yeah, that's probably true, but that is just not where we're at today. That brings up a whole other point around like, when are we going to get actual L2s that use fraud proofs to settle to mainnet, as opposed to like just trusting a centralized entity, which is the reality that we're living in today.
Yeah, strong agree there. Pibbles, I'll kick it over to you for your cool throne of the week.
Yeah, I have Aptos in the cool throne. I know everyone loved to just like, take a fat shit on Aptos when it launched because it launched in the middle of a bear market. But the token is up almost 4x in like a month. And now I think the fully diluted value is like 14 billion. So it's like the biggest L1 by FDV right now. But yeah, even through all the FUD, someone could have just 4x their money right there if they were paying attention. What's also funny about that is there's only 55 mil TVL on the actual chain, and one of the biggest protocols on there is PancakeSwap. But go people who longed Aptos. Good for you. It wasn't me.
Yeah, definitely. I was pretty early in bridging over there, just like one of those moods where I'm just like, I'm going to go, experiment, see what's going on with the full expectation of losing everything through not any large sum of money by any means, but through some assets in some shitcoins over there. Totally forgot about it. Aptos starts pumping, and I go back and check, and like a 3-4x on Aptoge, like. That thing 50x in a while, but that's just the reality of it is I went over there trying to do like legitimate things and like actually see what the chain has to offer. But I get over there and there's nothing built. It's just, we launched a chain probably because we have a horribly allocated token, and, vesting tokens can accrue rewards. So the faster we get the chain out, the more rewards we can get, the more money we make. Ideally you kind of like get the tech working through a couple test nets and then get developers building on test nets. And then when you launch, you actually have things built. It just seems like clearly a better way to operate a blockchain. But that's simply not what we got. So at the end of the day, the price did certainly pump. And, if you go back and look over there, there really still aren't any legitimate tokens over there. Everything that's like has the most liquidity on chain is like your USDCs, your WETH pools. It's pretty funny because even like the tokens are a complete mess because everything you bridge over there, there's like a layer 0 USDC and a layer 0 WETH, and then there's a wormhole USDC and a wormhole ETH. Like, so it's just so fragmented. But at the end of the day, they're in the cool seat because number go up.
Yeah, they've got like 50 million of TVL just on dexes, so pretty much everyone just going over there to swap coins around with each other. It's really funny actually. But do you guys know what valuation investors got in at there? Because 13 billion fully diluted. I'm curious how they're sitting here.
Surely 0.00001 cent. So they're probably chilling. I have no idea what the valuation was.
I think the last round that happened for Aptos was at a few billion. I want to say 3.5 billion, though I'm not sure. It's actually funny because I didn't realize this up until a few months ago, but the Aptos CEO, Mohammed, I followed like a startup that he did before Aptos. There was a shared property ownership on the blockchain. He started that off for a few years already, and I don't think that went anywhere until he started Aptos. And I think he's basically given up on that project.
I will say one thing to keep an eye on Aptos is it's something called like Tsunami. Maybe it's like Tsunami Finance. But I think they're just trying to be like perps on Aptos, but I mean, it is a high performance blockchain. Like maybe they can actually have an on-chain order book and stuff. So they're on like testnet right now, but I've been meaning to go over there and give that a try in case there's an airdrop or something. But I have not been over to Aptos yet, like Dan has. So I just saw I had to download a new wallet, and I just kind of like sighed. I don't know. Maybe I'll do it at some point.
No, that's fair. I have 2 new wallets, and like half my money was in each of the wallets. Like, I can give you some recommendations. Though one's definitely better than the other. But word of caution: I used Layer 0 to bridge over there. Seamless getting there, but to get back, you need 1 million block confirmations, which is roughly 3 days. So now I'm just sitting in bridge limbo for 3 days.
That's absolutely hilarious. 3.5 days, 1 million block confirms. That's absolutely crazy. Dan, I'll kick it over to you for chart of the day if you're ready.
Yeah, I'll get this thing shared up on the screen here. Again, we have a bounty running. So if you want to go ahead and even work towards answering a specific question, you get the opportunity to earn some free USDC. So before we jump into that, again, just want to thank Flipside for everything that they do in sponsoring this show. As usual, we do the Flipside dashboard reviews, and this is a dashboard built by Jack the Guy. So another common name we're seeing here. So shout out to Jack the Guy. And this one specifically covers Cosmos ecosystem voting. And it's pretty interesting. I thought, so if we look at this chart here on the top left, we have a bar chart from early in July 21 to current in January 2023, and it kind of just shows you the voter participation on chains throughout the Cosmos. Personally, I was expecting this to be heavily correlated to price action, but you see, we actually topped out in May, and that kind of gives me a little bit of this interesting feeling. May 2022, and that's kind of like when we were really in the depths of the bear market. And we really hit that second peak in price in November 2021 before trending lower. But there's actually a little bit more of an interesting story there. Is like once price started plummeting, maybe it was people coming on chain and being like, hey, like we need to fix things. Like let's optimize our chain to get more value accrual or things of that nature. So I don't know, maybe that's the takeaway here. But very interesting to see, governance participation really leveled out in between March and May of 2022.
That's a super fair take, I feel like, Dan, because like every other chart in crypto is just down and to the right. And I'm really surprised that voting participation isn't the same. I actually can speak from firsthand experience. Like I do vote on protocols that I've been invested in since the highs because I'm like, let's try and fix things and make this a little bit better. So this is a cool dashboard. I really like it.
Yeah, I think they should definitely just like hard code it to $100. That's what I would do as well.
I love it. And I guess the most interesting takeaway here is if you look at where we started in voter participation in late 2021 and where we're at now, we're like 5-6x off the bottom. So it's kind of cool to see just more users in general being interested in participating in on-chain governance. So that's kind of like my takeaway from this. But again, the only reason we can even see this is because Flipside is offering this free on-chain data, super comprehensive, covers 17 or so chains now. And here's a good little tidbit is their decoded logs table is coming live soon. It's currently in beta, but I've been messing around with it a good bit. It's based on Ethereum mainnet only right now, but it's eventually be rolled out to all EVM chains just because of the similarities between how the chains themselves operate. But this really enables you to analyze any piece of data that gets recorded in the event logs and is super, super powerful. So, again, if you're kind of new to SQL or SQL, which is the coding language that you use to build these visualizations, it's pretty easy to learn. Lots of free resources available to do so. And again, when you kind of have this like motivation to understand on-chain data, it just becomes super, super easy. And Flipside really makes that super powerful to make great analysis.
And I'd like to take a moment to thank our other wonderful sponsor, Chainalysis. They're one of the leading crypto analytics providers that are helping provide the tools to legitimize our industry. I mentioned it last week, but they just dropped their crime report in 2022 that measures the amount of illicit activity that goes on chain. And they found that 0.24% of on-chain activity was related to illicit activity. And a lot of the reason for that is the bridge hacks that we experienced last year, as well as the OFAC compliance list with Tornado Cash. So that's the first uptick we've seen since 2019, but it really does do a good job putting it into perspective. No one's really using this stuff to do illicit activity. It's a terrible idea. It's all public. Like you shouldn't be doing it. there if you want to launder funds. They also offer some really awesome courses, some other research, and we'll be sure to link to all that in the show notes. So thanks again to Chainalysis for sponsoring our show.
And now here is John Adler from Fuel Labs.
All right. Welcome back, everyone. We are joined by John Adler, the co-founder of Celestia and Fuel. We'll be focusing on Fuel today. And John also has done a lot of work in the research part of the space as it relates to optimistic rollups. So thanks for joining us, John.
Thanks for having me. Glad to be here.
Yeah, so I wanted to start out just kind of at a high level because Fuel is like a modular execution layer, and the four typical job functions of a monolithic blockchain are going to be consensus, settlement, data availability, and execution. Why did you choose to pivot into a modular execution layer, and what exactly does Fuel do?
Pivot from what?
Weren't you guys starting as a optimistic rollup on Ethereum, I believe, and then pivoted
Yes, that's
over?
correct.
Okay.
Yes. It might be a good time to distinguish what do you mean by just a rollup versus a modular execution layer. And then you'll see that maybe it wasn't so much of a pivot as much as it was like just coming into what we wanted to do all along. So one analogy I like to use is the analogy between USB and Thunderbolt, right? Like the USB specification says, here's some form factor, and then you can support such and such protocols. For instance, you can support display over USB-C. You can also support data over USB, right? Some USB cables don't have data; they just have power, and so on, right? And it's why if you buy a USB cable, if it's just a USB cable, it might not be capable of having display to a monitor, right? It might just be usable for charging your device. But Thunderbolt is the same thing as USB fundamentally. It's just USB with all the features enabled, and they must be enabled. So like if you buy a Thunderbolt cable, then you're guaranteed that it will be able to send display through, and you will be able to use it for also charging your device, etc., etc. Of course, they're more expensive. So this is analogous to how rollups versus modular execution layers work. So a rollup is primarily and only it only considers the validity of a bridge contract to a settlement layer. It doesn't necessarily have to be a settlement layer, but for now, for simplicity, let's consider a settlement layer. And the problem is that this is not the same thing as a light client, right? And I'll give you an example of why this is. Concretely, not as like a hypothetical example, but as some rollups actually do this. If you want to know that some withdrawal happened in some rollup, or if you want to know that some new block that is posted by the rollup block producer, the sequencer, is valid, you only really need to know that the block header is valid. And the block header consists of things like a state root and some commitment to transactions. In a normal blockchain, such as Bitcoin or Ethereum, this commitment to transactions is a Merkle tree, but it doesn't have to be, right? And a lot of rollups have taken a shortcut of, instead of having a Merkle tree, why don't we just make it cheaper? Why don't we just make it one hash, right? And this cuts down on the amount of work that the rollup needs to do, and you can still have a proof that the state root and the block header are valid, and the rollup will still function just as it normally does, right? Every block is valid, given certain assumptions. People can withdraw from there. They have all the nice security guarantees, and it's all good. But when it comes time to run a light client for this rollup, if the rollup doesn't have a Merkle tree of transactions, you can't actually prove that your transaction was, you can't prove to the light client succinctly that its transaction was included in the block. And Satoshi Nakamoto actually had an entire section in the Bitcoin design paper dedicated to SPV clients, light clients, right? Where he described, we're going to use a Merkle tree to enable light clients. If you don't care about light clients, you don't need a Merkle tree. You don't need a Merkle tree of the transactions. You technically also don't need a Merkle tree of the state, but that's usually needed for validity stuff. So that's a problem, because I would like to run a light node of my rollup, right? Otherwise, well, how do I even know if my transaction has been included in a block or not? I would have to trust someone, or I would have to run a full node for that rollup. And if the rollup has a very high cost to run a full node, now you see why that's a problem. So a modular execution layer fundamentally has the nice properties that you would get out of a rollup. In other words, it's some blockchain that runs alongside a settlement layer. You're guaranteed that it's valid and all this stuff, but it has these additional nice properties guaranteed. While in a rollup, they're optional because they're not the focus. And one of these nice properties is with a modular execution layer, you can run an off-chain like client, and it'll work just like a like client works today on any normal blockchain like Bitcoin or Ethereum. You'll be able to get a proof that your transaction was in the block. You'll be able to get a proof that the state of some contract was such and such at a particular block, and so on. And these properties are not guaranteed by just vanilla rollups. So with Fuel, we're building a modular execution layer. We're not settling for just a rollup. We want users to have the maximum security and the maximum flexibility across the whole stack. So why are we doing this? Well, I just answered why we're doing this, right? And we didn't really pivot away from doing this. I would say we didn't call it this when we were building Fuel V1, but we were building Fuel V1 with all these properties in mind.
Great, that's super helpful. So I guess if I'm getting this right, does it seem like today rollups are really optimizing to just fit as much transaction data to post to Ethereum as possible, and you guys are kind of taking the bet that data availability is going to become cheaper over time, and really state growth is going to be the main problem?
Yeah, so that's a follow-up point, and I think it's a very important one in how we design Fuel. You're correct that a lot of rollups today assume and are built under the constraint of very expensive data, or call data as it is called today. And we're building towards the very near future when you have solutions like EIP 4844, proto-dank sharding, then full-on dank sharding, potentially systems like Celestia or Eigenlayer that can provide greatly increased data throughput for rollups, and we're building towards that very near future instead of the current present. And why are we building towards it? Because we don't want to build a system that's going to become obsolete in a very short period of time. And we don't want to force developers and users to spend a bunch of resources and time and so on developing an ecosystem that, again, will be obsolete in like months, not years. So quite a few rollups today, their economic design and how they charge people for different things on the rollup makes call data very expensive. This has forced developers to rewrite their contracts to use less call data and use more state, which is a really perverse incentive because now you have these rollups that are just taking on state bloat at a much faster rate than Ethereum mainnet. And Ethereum mainnet already has a very big problem with state bloat. It's one of the big bottlenecks and big things that the core client developers have been trying to improve on, and that various protocol changes to the Ethereum protocol have tried to mitigate. And now you have these rollups that are basically undoing all that work that to the EVM and to the Ethereum protocol, and they're just letting people go crazy on state bloat, and it's really horrific. And this will come back to bite them because that state, you can't really discard it. You've now kind of locked users into having a system with all the state, and if you want to run a full node for this rollup, congrats, you need to sync just a huge amount of state, and that state is not going to disappear anywhere. So we're building towards a future that actually, ironically, looks more like blockchains did before rollups arrived, which is that state growth and state size and so on is the ultimate bottleneck. That was always the case, really. It's just currently obfuscated by expensive call data, and this is a transient thing. It will go back very quickly to call data is cheap and state is expensive. And when we're in that in that place, Fuel is well positioned to be way ahead of any other rollup that isn't actually working towards this.
So we jumped right into the deep stuff, but I guess just to take it back to a little bit of a higher level, do you mind kind of going through the different architectures that can be built using Fuel? Because I know there is like a bunch of different plug and play ways you could utilize it.
Yeah, so I wouldn't say that there are currently plug and play ways, but there will be plug and play ways in the not too distant future. This is a lot of implementation work. But we aren't, as a modular execution layer, we aren't building a system that must be a rollup that settles to Ethereum and only Ethereum, and that uses only current Ethereum mainnet as its source of data availability, right? We are building modular software in addition to a modular protocol, like a modular blockchain, The software is also modularized in the sense that it is agnostic to the data layer and settlement layer as much as humanly possible, and that is generic. So it's very easy for someone to modify the software. And for instance, instead of using Ethereum mainnet today for data availability, it could use Ethereum post EIP 4844. And that would be very easy because we didn't bake any assumptions into the software and into the Fuel protocol that it must use Ethereum mainnet as it exists today. Other projects are also working towards similar flavors of this. Optimism Bedrock, for instance, is a more generic form of optimism. Their pre-Bedrock work is very heavily linked to Ethereum mainnet, and it just like all the assumptions they make are around Ethereum mainnet must be the data layer that we use. Their Bedrock is much more generic, so I'm excited to see other Rollup projects also going in the direction of also building modular software.
And so just to like dive deeper into that state growth stuff we were just talking about, right? So what specifically is Fuel doing differently that, kind of shifts away from that the model of like, making really cheap call data and into kind of like solving that state issue?
So there's a few things it does. One of them, which is going to be very, very stupid and obvious, is, well, just don't make call data expensive. Just make call data cheap, and more importantly, make state rights expensive. I did give a talk about this at the Ethereum Community Conference last year. I guess last year, because we're in January now. So last year. And I kind of compared the gas schedule, like the way different instructions and different operations in blockchains are priced. I compare that to effectively regulation by the protocol itself in how it is used. And you can actually incentivize and like push people towards using the blockchain in certain ways through this gas schedule. So the simplest thing you can do is, if you want to mitigate state growth, make growing the state more expensive, potentially even more expensive than it would be like to physically grow the state. Make it even more expensive than that to like greatly discourage people from doing that. At Fuel, we also have a number of, given the fact that we can design a virtual machine from scratch and we don't require EVM equivalence, but rather we can say, let's take the EVM and let's improve on it. So it's not exactly from scratch. It's more like a VM based on the EVM, but with various improvements. But it allows us to make these improvements because we're not tied with backwards compatibility. And some of the improvements we can make there were various proposals throughout the years. And when I was at Consensus doing scalability research, I was kind of involved in something either directly or tangentially in some of these proposals around stateless Ethereum. You may remember from back in the day, it was called the Ethereum 1.x initiative. Or was it Ethereum 1x? I forget exactly how they branded it. It was 1.x something. That was trying to make the EVM stateless so that full nodes didn't have to store the whole state. They could store like a subset of the state or potentially even just the state root and be provided witnesses to the state as part of transactions. Now, that didn't go anywhere because the EVM has a bunch of things that make it not work with statelessness. But with the Fuel VM, we designed it such that it would be very conducive to make it stateless, because we knew all the constraints and all the issues that stateless Ethereum kind of ran into and couldn't overcome without major breaking changes to the protocol just for statelessness. But we don't have backwards compatibility baggage, so we say, okay, well, let's design the protocol from scratch such that it's very easy to make it stateless in the future if we need to. So there's various things like that you can have a gas schedule, and you can also have a protocol that's conducive to statelessness, which is kind of the ultimate solution to state growth. Make it so that you just don't store state at all, and then the state growth is solved.
If you can't tell, we love data here at Blockroots Research, and Chainalysis, the leading blockchain analytics company, shares this passion with us. We use data to extract alpha and find the next thing coming in DeFi, but Chainalysis is doing the gritty work and building trust in blockchains. To onboard the next $1 trillion of capital into the industry, we need to grow safe consumer access to cryptocurrency and promote more financial freedom with less risk.
Chainalysis has some of the most comprehensive and reliable data in the space, and they use this data to power a full suite of their solutions that can be utilized by industry professionals. Best-in-class training and certifications are also led by Chainalysis and some of the brightest minds in the space. If you haven't heard of Chainalysis, you got to check them out, and we'll link to them in the show notes. do you mind diving in? I guess we'll start with UTXO and how that differs from Ethereum's account-based, model.
Sure, I can talk about UTXOs, how it differs from Ethereum, and also how it differs from Cardano, because that's another blockchain that purports to use UTXOs while also allowing smart contracts and stuff. And I can also maybe explain how this is related to Bitcoin as well. So Ethereum uses accounts for representing user balances and contracts, and just state in general. So what's an account? An account is, well, there could be contract code if there's code, but if not, it could be like just an EOA, an externally owned account, which means that it's like a private key. It's a public-private key pair, right? Which is like just an address. So it could either be an EOA or a contract, and then it has some ether balance, and it also has a nonce. And the only reason you need a nonce is to prevent replay attacks. It's essentially a way of uniquifying actions that the account takes, right? So if it's an EOA, you want to sign over, if the EOA is Alice's, you're going to sign over a transaction that says Alice sends 5 ether to Bob with a unique nonce. Because if you didn't sign over a unique nonce, then Bob could just take the signature and replay it and get another 5 ether and another 5 ether, right? So you need some way of uniquifying this action of sending 5 ether. UTXOs work a bit different in the sense that a UTXO transaction just a UTXO data model doesn't have like these notions of accounts with a nonce, right? Rather, every single thing that is sent is its own unique state element. So if you have 5 ether and you send some to Alice and some to Bob, you're not incrementing Alice's balance by, let's say, 2 and Bob's balance by 3. Rather, you're giving Alice a 2 ether coin and Bob a 3 ether coin. And these coins act independently of the other coins they have. So every single thing is its own independent state element. And just by construction, it means you don't need a nonce because every element has a unique ID, starting from the genesis of the chain. Effectively, you just kind of have a chain of hashes, right? And as long as you start from something unique, which obviously you do because it's a blockchain, then every hash in the chain, the hash, just by the properties of cryptographic hash functions, right? The hash of something, if you just keep hashing and hashing and hashing, you should never get a collision. Because if you do, well, then the hash function is not collision resistant, right? So that's basically how UTXOs work, is that you just keep hashing the previous things, and this is the giant like hash onion. Obviously, you can mix some stuff in and so on, but regardless, by construction, it means you don't need a nonce, which is pretty nice because it means that you can actually fully consume state. So like if Alice takes her 2 ether coin and sends some to Bob and Charlie, she no longer has that coin, and the notion that that coin ever existed does not need to be kept track of. Right? If Alice completely empties her account on Ethereum, you still need to keep track of the nonce because you don't want to then have someone replay her earlier transactions after she reloads her balance. So in the accounts data model, you kind of always need to keep track of a nonce, and UTXOs you don't, which is nice, but that's maybe a bit minor, right? It's not like the most big thing. Oh, okay, you keep track of a nonce, big deal, right? The really important thing with UTXOs is that they enable you very easily to do parallel transaction execution, because you can just look at 2 transactions and you can say if they touch UTXOs or if they touch state that is completely disjoint, then they can be executed in parallel, right? There's no dependence between the transactions. Therefore, you don't need a total ordering. They don't need to be executed one after the other. You can execute them at the same time because there's a partial ordering, right? And this is very powerful because modern computers haven't really gotten much faster in single-threaded performance, but they have like a shitload more cores than they did 10 years ago, right? So they have way more multi-threaded performance, not so much single-threaded performance. Let's leverage those extra cores that are literally just sitting there. Like if on an Ethereum full node, just running one core at full throttle, which is like fine, but then the other, like, if you have a 16 core processor, the other 15 cores are just sitting there doing nothing. That could be validating transactions, right? We would like to unlock that. So UTXOs happen to be just baked into the transactions themselves. You have to say, I'm touching these UTXOs. And if you know which UTXOs the transactions touch, it's trivial to parallelize execution of transactions. And there's a few other reasons to use UTXOs, but that's one of the main benefits that we effectively get for free. And this is different than basically any other rollup, is that we get parallel transaction execution for free. So now I should probably talk about how smart contracts work and how those are different than Bitcoin and Cardano, because we went over kind of the performance benefits that differentiated from Ethereum. Now, in terms of smart contracts, how is it different than Bitcoin and Cardano? So Bitcoin has smart contracts. It's like a common saying that it doesn't have smart contracts. It does, but its contracts are stateless. So Bitcoin smart contracts do not have access to some state that can be updated over a period of multiple transactions. So, for instance, a Bitcoin transaction could be multisig. So, or not a Bitcoin transaction, but rather, if I want to be technical, the spending condition of a UTXO in a transaction could be like a multisig, right? So it could be something completely stateless, like 2 of 3 signatures from these 3 public keys, right? That's stateless. You don't need anything that crosses multiple transactions, right? It's just like a multisig, completely stateless, right? As long as you can provide 2 of 3 signatures from the set of 3 public keys, then spend the UTXO. You're all good. Something like Uniswap, however, right? Uniswap relies on state, right? There's an LP pool, and the X and Y, the amount of each token, actually gets updated after each transaction, right? And like a subsequent transaction needs to know the effects of a previous transaction in order to actually calculate the price of an asset, right? That's stateful because it relies on some state that actually gets updated over multiple transactions. And that's kind of the main differentiator between how smart contracts on Bitcoin and Ethereum work. Now, we would like to have stateful transactions like Ethereum, but we would like them to also be able to be executed in parallel and leverage the power of UTXOs, right? So how does Cardano do this? The way Cardano does it is they effectively have a hybrid system, and we also do, where contracts are effectively accounts, right? And if 2 transactions touch the same contract, right, then similar to Ethereum, those 2 transactions must be executed one after the other, so sequentially. And this is reasonable. What's unreasonable about Cardano, though, is that their system is that users will sign over the effects of a transaction in their entirety. And this is what you do in Bitcoin, right? You sign over the whole transaction and its effects. And the reason you can do this as a user very easily is because all the UTXOs are stateless, right? All the spending conditions are stateless. So it doesn't matter what anyone else does. The effects of a transaction in Bitcoin will not change. The transaction could become invalid if someone double spends one of the UTXOs that are being spent by that transaction. But other than that, the effects of the transaction will always be the same in Bitcoin. From the time that you sign it to the end of the universe, the heat death of the universe, they'll be the same because transactions are stateless. Right? The spending conditions, rather, are stateless in Bitcoin. In Cardano, they're not, and in Ethereum, they're not, right? If I make a trade on Uniswap, the amount I get, that's maybe a bad example because technically the amount I get thanks to MEV bots will always be like the lowest slippage I set, right? Or rather the highest slippage and the worst price. But okay, like that aside, right? The amount I get from the trade, right, depends on the actual amounts in the pool, and that depends on all their transactions. So if I sign a transaction, I say, hey, this is the exact result I'm going to get from this trade. Imagine you do that on Ethereum today, right? You say, you set the slippage to 0. What's going to happen to your transaction? It's going to revert, right? Like 100% guaranteed. Like it's not like 99%. It's like 100% guaranteed. You sign your transaction, right? You set slippage to literally 0. It's going to revert, right? Because someone else did, they did a trade before you, right? The chance that you get in first, exactly as soon as you sign it, is almost 0. Right? Someone else gets another transaction in, they move the price a little bit, your slippage is non-zero, right? And then your transaction reverts. And that's basically what happens in Cardano, except instead of reverting, they actually make your whole transaction invalid. Because in their UTXOs, you have to sign over the effects. And if those effects are not actually what happens, then the transaction is invalid. Which basically means you had a system where users would try to make a swap, they would sign a transaction, they would send it, and they would get back, hey, the transaction is invalid. If you want to try again, sign a new transaction. They'd have to go in their hardware wallet and sign a new transaction and try again. Then, of course, if there's 10 people using the DEX, they're going to get back again an error saying, hey, someone else got it in front of you, sign the transaction again. And this is obviously completely horrific, right? Like there's no way this system will work at any scale whatsoever, let alone with 10 people. Now imagine you scale it up to 1,000 people, right? All trying to make a USDC, I guess ADA in that case, if it's on Cardano swap, right? There's no way this system is tenable, right? It's tenable on Ethereum because on Ethereum, you don't sign over the effects. You only sign over, this is the action I want to take. Let the effects be what they be, right? And we at Fuel, or rather the Fuel protocol, takes that approach, where users do not sign over the effects, they sign over the actions. And there's actually nothing stopping you from doing this in the UTXO model. Like people don't think that you can do this, but it's like, you totally can. We're all consenting adults, and there's nothing stopping you from having a protocol where you just sign over the action, but not its effects, and let the effects be decided later. And that's it. Like there's no like special secret magic other than that. It's literally just we take UTXOs, users sign over the actions, and away they go. So this enables basically the best of both worlds. You get the flexibility and ease of use of Ethereum, and if the user uses a Fuel DEX like they would an Ethereum DEX, and they don't use, like our UTXO system has a bunch of other flexible stuff. It has account abstraction, it has transaction script, there's a bunch of fancy stuff. But if you don't use any of that, if you use Fuel like you use Ethereum, it is an identical experience to Ethereum. You just interact with the DEX, you sign a transaction once, you send it off, and it just goes, right? I'm assuming like someone doesn't try to like market sell 1 million Ether, then you're fine. Your transaction will just get through. Right, and this is different than systems like Cardano and especially Bitcoin, because Bitcoin can't even support stateful smart contracts. Period. Right, and so it combines the best of both worlds. You get the parallel transaction execution and performance from UTXOs, while simultaneously getting the flexibility and ease of use of Ethereum.
So one thing we commonly hear in this space, right, is there's trade-offs with everything, and this system almost sounds like there isn't trade-offs, right? You're picking like the best pieces of both models and kind of combining into this current model. And so when I hear that, it's like, first of all, it's incredibly exciting. But do you have any in these first two beta test nets? Were there anything that came up that like, okay, here maybe this portion is the trade off that we're going to have to make for users?
I mean, there have been. I mean, let me see if I can think of a good analogy. Let me think if I can think of a good analogy that actually has no trade offs. I mean, it could be as simple as let's say we have a faster implementation of some cryptography thing, right? Just as secure, right? Like if you have that, then there's no downside to just using it, right? Like there can be cases where you can have a thing that is strictly better, like it's just faster and also just as secure, even more secure, right? And the reason for this is that the thing that is the current status quo could just be not great, right? If it's not great, then it's pretty easy to strictly improve it. Obviously, if you're already pushing the bounds of like optimality, then it might be hard to find something that is strictly better. But like if your base is not great, it's pretty easy to find something that is a strict improvement. And that's basically what we have today, is that the EVM, when it started, was very rough. It had a whole bunch of patchwork changes over the years that were necessary in some ways because of the backwards compatibility baggage requirement, because there were contracts live in Ethereum, and the Ethereum community and developers didn't want to break those contracts. Right? That's kind of like the social, community, like, I don't say law, but the understanding that let's not break the contracts as much as possible. There's a few that broke, but okay, as much as possible, let's not break these contracts. That's our social contract. That's what the word I was looking for, social contract. So there's kind of a requirement on the EVM. So this isn't really like the fault of anyone. It's more like it started very rough because no one knew how to design a blockchain EVM that was stateful and all the stuff. A bunch of patchwork changes, and now it's in a state where there's a bunch of things about it that are just suboptimal, and we know better from working on Ethereum and the EVM itself. This isn't like some random person just shows up out of nowhere, right? Who's never touched blockchain before. There's we've made many changes to Ethereum, and we've also made many proposals, and not like me personally, but the Ethereum community and developers have made proposals to improve Ethereum, but they couldn't go in for the one reason that it would break backwards compatibility, right? And it would break some contracts. when you're starting a new chain and then you roll up from scratch, you don't have state, right? Your state starts from, you have an empty state at chain genesis, so you can do whatever you want, right? And then you can make changes that are strictly better, but that are not backwards compatible, which I think maybe is the part where you can say it's maybe not strictly better, in the sense that some tools, some language features, some other stuff may not work out of the box with a new system, because the new system says, okay, we're going to make some changes that are explicitly not backwards compatible. They're breaking, so your tools won't work. And that's kind of where the con is. But this, importantly, is not a protocol thing, right? It's purely, well, if the tools don't work, can you make the tools work? All right, or can you make better tools? But it's not like a fundamental protocol thing. Like, this is like purely just engineering work, maybe make the tools work or develop new tools, but it's not like a fundamental protocol thing that, the fundamental trade-off that will never be fixed. It's purely just engineering work. So in that sense, it's a very good trade-off to make, because engineering work can be solved by just working.
Yeah, we can definitely dive into that. And I also know you guys have spent a lot of time on the Fuel toolchain itself, and like taking the focus of, okay, well, if this is the trade-off, then let's invest in that and make it what we believe it can be. So can you talk a little too, not only the backwards compatibility features, but also the work that's gone into the Fuel toolchain?
Yeah, so perfect. Led us to the next question, which is, okay, if we can either make the existing tools work, which is possible. There's no fundamental reason that things like Solidity and Foundry and Hardhat couldn't work with the Fuel protocol. Like, fundamentally, there's nothing really stopping that. But could we do better? Could we actually build better tooling that works for the Fuel protocol and the Fuel virtual machine, but potentially also for Ethereum? And the answer to that is yes. And that comes in two facets. One of them is a new language called Sway. The other one is, a new toolchain centered around Fork, the Fuel orchestrator, but that really has some other extensions. So I'll start by discussing the language and why it's not just a good thing to have, but why I think it's needed. Right? So surely most of your listeners are familiar with Solidity. If they haven't written it, they've surely heard of it. Right? It's basically the only language that people can use to write smart contracts for Ethereum and the Ethereum virtual machine. Viper, I guess, is an up-and-coming... Well, it's not up-and-coming. It's actually quite old. But, it's kind of gaining features and stuff relatively recently. So, sure, up-and-coming. It's an up-and-coming language as well that a few projects use. But by and large, the most used language by like a wide margin is Solidity. And Solidity is not great. And I don't say this just because I have like a personal vendetta against the language or its authors, but rather I've written like a decent amount of Solidity, and other people on the team have written like a pretty decent amount of Solidity. And it's not a great language. And not just because it doesn't look great, but because it has a bunch of things in it that aren't safe and that aren't well designed. So let me start by describing some things that are unsafe and tell you why. If we had okay, well, I'll start by saying here are some things that are unsafe, and then Sway fixes them. Sway fixes this. So one thing that would be unsafe is there's a mechanism in the Ethereum virtual machine to get the signer from a signature and the message that they've signed. Right? You can get, what is the address that signed this? This seems like a pretty reasonable operation, right? Pass in a signature, pass in, here's the message they signed, and then you get back an address. Fantastic. But here's the problem. The problem is that what happens if, for whatever reason, because of the cryptography and stuff, that you can't actually get the signer of what happens if you can't get the signer? And this could be, there's some like weird cryptography corner cases, but it could also just be that the signature and the message don't match up. Right? They just gave you just random garbage. Right? You just had someone just feeds in random garbage, right? What does Solidity do? Solidity returns with no indication that there's an error. It just returns the address 0. So like 20 bytes worth of zeros. And that's all this returns that. Now here's the thing, unless you go in yourself as a developer and read the documentation that, hey, there's a corner case here. There's a case that if the signature is invalid, that you're going to get back address 0, and you have to check for that, then it could be the case that if you don't check for that, then basically anyone in the world could impersonate address 0. Now imagine if you used address 0 for holding like a bunch of coins that you burned, and anyone can impersonate the address 0 by just sending an invalid signature. Do you see how that would be terrible? Because then they can just withdraw all the coins of address 0. Anyone in the world can do this by just sending they just generate some random 65 bytes, and then they steal a bunch of coins that were supposed to be burned, right? But there's nothing in Solidity itself that encourages you or forces you to actually check that case. Now, what do modern languages do, such as Rust? And Sway is a Rust-based language, so it takes a lot of inspiration from Rust, but adds a bunch of blockchain-specific features, and specifically for the Fuel VM and also the Ethereum virtual machine, because those two are very similar, as first-class citizens in the language, which also means that you can have native support from the Sway compiler for those features. And we'll get to in a second examples of why that you can do something in the Sway compiler that you can't do in the Rust with a Rust program using the Rust compiler. So, where was I going with this? So, in Rust, you have this notion of a result. And the result can be one of two things. A result can either be okay or it can be an error, right? And the function in Sway, because Sway also has this, the function in Sway that allows you to recover the signer address does not return an address. It returns a result of an address. So what that means is if the operation completed successfully and it returns an okay result, it will contain the address, right? The address of the signer. But if the operation was not successful because the signature was invalid, it will return an error result, right? So it effectively wraps the address in a result, and then it'll tell you, is this okay or is it an error, right? So it's additional information. And the important part is to get the address, you can't just use the address right away. You actually have to unwrap it, right? You have to unwrap it and go into the okay or the error. And this is enforced by the type system of the language, and the compiler enforces this. So you cannot write a Sway program that does not try to either unwrap the result or that checks both arms. So it has to exhaustively check, okay, is it okay or is it an error? And you can't write a Sway program that just directly uses the address without doing one of those things. While in Solidity, you can write a Solidity program that just directly uses the address, and there have been many cases of developers forgetting to check for address 0. So this is something where fundamentally at the language level, people can't even deploy such a contract. The compiler will not compile a contract that does not unwrap the result because it's just not valid. It's not valid Sway, right? And it wouldn't be valid Rust either because it's based on Rust. Right, so this is an example where the language itself stops you from shooting yourself in the foot. You don't have to read any docs. You don't have to do anything else. You just write Sway code, and there's no possible way for you to get it wrong. And modern languages are built like this. They stop you from shooting yourself in the foot, and if you try to shoot yourself in the foot, then they stop you from doing it, and they give you big warnings or big errors that describe exactly what you're doing wrong, right? And it should be a no-brainer to anyone that the best way to stop people from losing a bunch of money is, make sure that developers can't write bad contracts, right? Don't trust the developers to be 10x coders that can, just write inline assembly and write a whole contract in assembly and not make any bugs. That's crazy. That doesn't scale, right? That's very unsafe. Make the compiler do a bunch of work to make sure that contracts are safe. And this is why if you go to the Sway repo, and I'm going to go right here to make sure I don't get the quote wrong. If you go to the Sway repo, this is different than many other blockchains or many other tools and stuff. A lot of tools say, oh, I'm so fast, I'm so performant, right? All that stuff. If you go to the Sway repo, the quote that it says is empowering everyone to build reliable and efficient smart contracts. Not fast. It's not that the compiler is fast. It's not that the contracts you write are going to be fast. They're going to be reliable and efficient. So they're not going to be wasteful. And most importantly, they're going to be reliable. Safety is the important thing. because it doesn't matter how fast your blockchain is. If people can't write safe smart contracts for it, people will lose money. So what's another example where Sway, and one of the reasons we don't go for Rust, what's another example of Sway and the compiler providing you additional security guarantees that Solidity does not? There's two of them. One of them is payability. The other one is reentrancy. Let's cover payability first because it's a less exciting one. And I'll save the most exciting one for last, the reentrancy. So payability. So what is payability? It's a keyword that was introduced a few Solidity versions back. And the developers of the Solidity language, like the compiler developers, had the misguided notion that, hey, we want people to stop losing Ether. We don't give a fuck about tokens, just Ether, right? We want people to not lose their Ether. So what we're going to do is we're going to introduce a new keyword, payable. If someone says an ABI method is payable, then it can receive Ether. Fantastic. But if a method is not payable, in other words, if they don't type in, okay, I should type like this. I actually type with my fingers, but okay, a normal person types like this. Okay, so payable. So they don't type payable, right, which is like, I don't know, 7 characters or something. Yeah, 7 characters. If they don't type those 7 characters plus a space, so 8 characters in total, into the API method, the compiler will actually inject into the runtime bytecode that is A, you have to deploy it, so it costs you to deploy, and B, every single user that runs your contract, runs that API method, needs to execute that code. There's a shitload of gas being wasted. All the Ethereum full nodes in the world have to then execute these checks, and they check, hey, are you trying to send Ether to this function? If you are, then I revert, right? And this is not good. It's not good because it increases both the contract bytecode size, which is a big problem in Ethereum specifically, because contract sizes on Ethereum are limited. In Fuel, we don't have an unlimited contract size, but we have a much larger contract size. Technically up to 64 megabytes, modulo some overhead and stuff, as opposed to the 24 kilobytes of Ethereum. So you get a much larger contract. So in Ethereum, contract size is a problem because if you have to split up your contract into multiple smaller contracts, you can incur much larger overheads by having to call between contracts instead of just having to do a simple jump within the same contract. So it's very bad that bytecode size increases with payability because it's very easy to hit the 24 kilobyte limit. If that limit wasn't there, then maybe the bytecode size wouldn't be so bad. But because of that, it's a very big problem. The bigger problem, of course, is the runtime cost. It means every single user that interacts with your contract, not just directly, but also indirectly through other contracts, has to pay this cost, right? And it's ridiculous. And what have optimizers done? They've started, they just add payable to everything. If I add payable to everything, then the compiler isn't generating that runtime code, and therefore my contracts are cheaper. And instead of relying on this code to save users from shooting themselves in the foot, I'll just let the wallet do it, right? The wallet should just not let you send Ether to to some particular endpoints, right? Let the wallet do it, or let the app front end do it, right? Just rely on the front end developers, right? Like if you're all on the same team, just rely on the front end developers to not lose user funds, right? That's where the work should be. It should not be every single Ethereum full node verifying that the wallet didn't do its job. Just wallet, do your job, right? And again, this only applies to Ether, not even to tokens. Fuel does support multiple native assets, so payability analysis also applies to tokens on Fuel, not just Ether. Now, the icing on the cake, or the cherry on the icing, whatever you want to call it, is that the Solidity developers actually tied a runtime code generation thing with a compile time check. The Solidity developers also have in the compiler a check that if you try to call a payable function and forward Ether at compile time, if you try to call a non-payable function and you try to forward it Ether, it'll tell you, hey, you can't do that at compile time. And this is a good check because it's free. It happens at compile time, right? Users don't have to deploy any code. That's a pretty good check, right? It prevents you from accidentally calling a non-payable function when sending it Ether. But therein lies the problem. The problem is that they've tied together this analysis with a payable keyword, and they all bundled it together. And because optimizers have started putting payable everywhere to avoid the bytecode being generated, it means that this analysis never actually runs because people just put payable everywhere. And of course, you can send a payable method Ether, right? So this is an example of a short-sighted feature that just should never have been introduced without actual product research. like user and developer research, and B, there are actually suggestions now to just straight up just remove this because it's useless. It's worse than useless. It just adds verbosity, and now just people put a payable everywhere, and it's useless, right? With Sway, we have the payability, the compile time payability analysis I mentioned, but it happens entirely at compile time, no runtime. And not only that, this is supported not just in the language, but it's also supported higher up in the stack, such as the SDK and such as the wallet. So it's not just something that happens in isolation. Because at Fuel Labs we developed the entire stack integrated, it means that we can have things like the compiler developers talk to the front-end developers and the SDK developers. They all talk to each other, and they develop features that the whole stack can use and actually does use, which is different than the Ethereum ecosystem. So now on to reentrancy, which is the most exciting part, which is that every week I go on Twitter, every week reentrancy, what devs do something, right? There's a new reentrancy exploit. Someone has lost money because of the same thing that the DAO got hacked by. People have not learned. And it'd be very easy for a compiler that is configurable, because it's like a compiler for a language that you control completely, such as Solidity or such as Sway, to check, hey, are you violating the check effects interaction pattern? If you are, then you could be vulnerable to reentrancy, right? This is like the check effects interaction pattern has been known for years, right? It should be easy to check, and yet auditors aren't catching it exhaustively, right? And you could say, oh, just use Slither, just use some like verification tool. But why are people having reentrancy issues even to this day? Because people don't use Slither, right? Uniswap, the Uniswap router from the Uniswap Labs team, not like some third-rate foreign developer that couldn't speak English, right? The Uniswap Labs team, they had a reentrancy vulnerability, right? The notion of, just use this such and such third-party tool that's hard to configure, et cetera, not well supported, not well documented, just use a third-party tool is baloney. No one does it, and that's why the Uniswap router just a few weeks ago was found to be vulnerable to reentrancy. These kind of things need to be built in to the tools by default, that you cannot write. I don't want to say Solidity code, but you can't like, if you can write your smart contract without running these tools, then the tool is useless. And that's why reentrancy checking is built into the Sway compiler. You cannot write a Sway program without this being checked. It is first-class analysis, as opposed to requiring a third-party tool that may not go out of support, may not be supported with the latest release of the language, et cetera, and that you may not even run or may not even know about. With Sway, the analysis is done, and it must be done if you want to write Sway. And the Sway compiler will actually check, hey, are you violating the check effects interaction? If you are, as reentrancy, it'll warn you. Potentially it could error. There's a bit of debate between if it should be a warning or an error, because reentrancy is such a big thing. But regardless, it'll actually analyze and catch this. And you couldn't do this if we were using the Rust compiler, because the Rust compiler doesn't know what check effects interaction is, right? If all you were doing is just using like the Rust, if all you're doing is using the Rust language, right? Okay, sure, you can write an SDK for your Rust language, and if you use it idiomatically, in other words, if you don't violate check effects interaction yourself, then okay, you're now vulnerable to reentrancy. I mean, that is tautologically true, but it's also useless, right? Because then the compiler isn't doing any work. And that's what distinguishes Sway from Rust, and that's why Sway is the premier and safest smart contract language, because it takes all our learnings around the specific vulnerabilities of blockchain programs and blockchain contracts, and it can add all the security checks into the compiler. So again, it's not about, it's not blazingly fast compiler, right? The compiler is pretty fast, right? But our goal is not to write the fastest compiler. Our goal is to enable reliable and efficient smart contracts and to empower developers to be able to write those.
Well, that was a lot. I'm definitely going to have to go back through and re-listen to this episode. But I do have a question I've got to ask you as someone who comes from the Ethereum community first, and that's pioneering kind of the modular movement. Ethereum's core value proposition is like kind of the decentralization ethos. So I hear you talk about trust minimized light clients, the ability for users to run full nodes. If there are DA layers and, modular execution layers that can truly decentralize, like how do you think Ethereum fits into kind of the modular future?
Yeah, so I don't really envision Ethereum going out of style in terms of its settlement layer capabilities. It is still the premier settlement layer for smart digital assets, if you want to call it that, programmable digital assets. There's not really any second best there, because Bitcoin doesn't provide you that level of programmability. And there's no reason that Ethereum can't remain the settlement layer for the foreseeable future. In terms of data layers, Ethereum is working relentlessly towards improving itself and adding improved data layer capabilities, both natively through things like dank sharding and proto-dank sharding, along with through the help of third-party, synergistic systems such as Eigenlayer or Celestia that can either bridge or restaking or what have you to improve its data availability capacity while retaining certain properties of Ethereum. So it's definitely going to be the center focus for the foreseeable future for any blockchain that wants to connect to anything reasonable.
Interesting. Now, I just have one more question as it relates to fuel, because you've already been so generous with your time. But where does the value capture come into play? I imagine MEV is going to be pretty prominent in this architecture, but correct me if I'm wrong.
Yeah. So since it is a smart contract platform instead of just a payments platform, then yes, there will inevitably be MEV, and that MEV will be capturable in the form of transaction fees for the block producers if this is decentralized block production.
Interesting. All right. Well, great. Do you want to share with people where they can find you and learn more about Fuel?
Yeah. So if you want to follow me directly, I'm on Twitter at @JAdler0. If you want to follow Fuel Labs and the work that we're doing, you can follow us at Fuel Labs _. So Twitter is probably the best place to reach out for either news, updates, anything like that. And yeah, we'll also be at ETH Denver. I'll be making a pretty big splash there, hint into Alpha Leak. So be sure to check us out there as well.
Great. Thanks so much, John. We'll catch you later.
Thank you so much for having me.